Hello everyone, my name is Sriram Iyer. I'm an analyst at the Commodity Research Desk at Reliance Securities. Welcome everyone to this week's Bullion Podcast, weekly podcast. International gold prices and silver rose last week. US consumers continue to face inflation or rising inflation pressures with consumer prices hitting the highest in nearly 40 years. Data from the Labor Department shows that consumer price index increased 0.5% last month. But in the 12 months through December, the CPI surged about 7%. However, inflation continues to be a double-edged sword for the gold markets. Although inflation will keep the real interest rates low, the rising consumer prices are being met with the expectation that the Federal Reserve will take aggressive steps to cool down the economy. Investors and analysts and many people and market investors now expect that the US Central Bank policy setting Federal Open Market Committee FOMC will raise its benchmark overnight interest rates from current near zero level at its March meeting and continue with 3 more quarter percentage increases over the year. Meanwhile, US Commerce Department data from that Commerce Department also showed that the retail sales dropped by about 1.9% last month, surprising many people in the market. But the biggest factor behind the dismal numbers were the inflation side of thing again. Market also got a lift from slightly weak dollar, even though dollar recovered on the last trading day on Friday. Overall, the markets, or I should say the dollar, was weak throughout the week, and this also lent support to the gold and silver markets last week. Looking at gold is already looking at two major obstacles it needs to overcome to terms with surging US Treasury yields, which remained on the firmer side last week, and the Federal Reserve quantitative tightening. The gold market could continue to struggle as investors will focus on the impending pivot in the Federal Reserve monetary policy. However, the major driver of prices will be the inflation side of things. Investors will focus on the bigger picture as inflation, or I should say rising inflation, will keep real interest rates in a low to negative territory. The US Central Bank's current stance of incremental rate hikes means that they will never be able to get in front of the inflation curve, and if the Federal Reserve was serious about inflation, it would have to raise interest rates to 5 or even 6% going forward. So additionally, if the US Federal Reserve also wanted to show the market that it was taking current inflation situation seriously, it would be looking at a surprise. It would looking to surprise the market with a potential move as early as this January meeting, which is scheduled for the last week of January. So I think the major trigger for the market in this week will be the Federal Reserve meeting in the last week of January. Of course, small data from the US and other nations will also move the market, along with the major trigger coming from the movement of the US dollar and the Treasury yields. But the major trigger will be the US Federal Reserve meeting, which is expected on 27th of January. So till that time, we feel that spot gold on the international side will remain within the trading band of 1850 on the higher side to 1775 on the lower side. We are giving up quite a big range because markets will continue to remain volatile ahead of that Federal Reserve meeting. On the domestic side, the range for the gold on the future side of things for the February contract is from 48,400 on the higher side to 47,400 on the lower side of things. For silver, the upper band range, or I should say upper resistance, is at 23.985, and market can test that level. But if the markets consolidate below 23,465, markets could touch the support zone of 22,300. On the domestic front, support zone is at 60,440 to 59,280 levels, and that will be the main support zone for the markets in the coming 2 weeks. On the resistance point of view, 62,600 to 63,600 will be the resistance zone for the market over the next week, as the market looks ahead to that Federal Reserve meeting next week. So that's it from our side. Thank you for listening. Have a pleasant week ahead. Thank you.